We're now going to get into sales of businesses. Generally, you're going to sell, generally anyone who buys your businesses is generally going to want an asset sale. Why? Because if they do a stock sale, they're buying your liabilities. Okay? They also, to the extent you have significant equipment, they get to write that equipment up to fair market value and then redepreciate it. So therefore, buyers love asset sales. Sellers don't like asset sales because to the extent of depreciation recapture, you're going to have ordinary income on sale. Okay? If you sell equity or you buy equity, you're going to structure the deal slightly differently. And was it Alan who spoke this morning? Alan talked about escrows. The idea here is that if you're buying or you're selling, you're going to say, I'm going to take 10, 15, 20% of the purchase price, and it's going to be held in an escrow account for 6 to 12 months. Why? Because when I'm as the buyer, I don't know that someone's going to come out of the woodwork and ask for a whole bunch of money for a liability, and I don't want to have to chase you. So the idea up front is you say, I'll buy your stock, I'll give you the favorable tax treatment, but I'm going to hold back a chunk of money to make sure that none of your creditors come out of the woodwork and bite me. Does that make sense? So you can...
It's an escrow account.
Yeah, basically, exactly. It's an escrow account.
They can't take it out arbitrarily.
No. It's usually held by an independent, usually by buyers, either seller's counsel usually is the escrow agent. And we're going to talk about escrow agents in stock deals too, because it's also your form of security. Equity sales or sales of stock. As I said, if a company, here's a structuring point for you. Let's say that you want your child to become the owner of your business. If you are the sole owner, you will sell your son 1 or 2 shares of stock because he's going to have to pay for that in after-tax dollars. The rest of the stock, you're going to sign a stock redemption agreement with the company, and the corporation's going to redeem the stock and take advantage of the tax spread if you're a C Corp. So the idea here is, and also, I'll spend a few minutes on structuring of family transactions, which I've done a lot. But we're going to talk about notes and so on, gifting of stock and versus sales, etc. We'll get to that. Merger. You merge with another collision shop. Tax-free until you until you sell the underlying stock. However, as I said before, I'd always rather I was in a deal than begging to get out. So what we did with with 4 shops, 2 families owned it. What we did was okay. What we did in this case is, as I said, if you merge these companies all together into one, what happens if you don't play well in the sandbox together? The concept of a management company is that what you do is say, okay, I think we can work well together. I think we're going to save some money through purchase discounts with paint, other types of purchase discount, potentially being able to hire a good CFO that's now we do this for 12 months, 12 to 18 months, this management company. And then at the end of 12 to 18 months, they can then merge in. If they merge in and then it doesn't work, breaking these 4 separate companies back up again becomes impossible. So the idea here of saying, we're not merging until I know that we all can work together. So we use this management company as an interim step to make sure that it works well together, everyone plays in the sandbox well together. And then we're rolling them up into a merger. So this is something, it's different than a holding company because this will become the holding company. But all this right now says is that each of these companies sign a management agreement that said it's going to collect all revenues, pay all expenses, and take a percentage for doing management.
And at the end of that,
At the end of that period, then it becomes the holding company. And you can contribute the stock into the holding company, and there is no tax consequences for doing that. So as I said, is making sure that you have the right partners. Because also, as I said before, everyone's going to exit. But if the partners are not thinking along the same lines, then they are not rowing the boat in the same direction. And I think everyone knows what happens if you have 2 rowers and they're not rowing the boat in the same direction. The boat goes in a circle and goes nowhere. One of the things that I do with a client with partners is I have a questionnaire that I have developed for the partners to talk about how they fit in the business today, what their strengths and weaknesses are, some questions on how they communicate, and saying, okay, 5 years from now, tell us about the business. I had one of these meetings with a client a couple of weeks ago, and I got the questionnaires in advance, and I said, before we start, first thing I got to correct is, one partner says he likes being at work 50% of the time, and the other one says he likes 90% of the time. I said, the first thing we got to do is get the guy who's at 50% up, because this partnership is not going to work if you're loving life and he's hating life.
or get the other guy down.
Well, and actually that's possible too. Not necessarily as good. But the other point is that by doing this 5-year, we can look and say, okay, do we have consensus to build a 5-year plan? In a couple of cases, I've ended up having to negotiate what I thought ended up being amicable business divorces because both partners realized after we went through what their goals were, they weren't the same. So the idea of making sure, and then that questionnaire and the 5-year piece begins the beginning of a 5-year plan that then you can then develop the measurable milestones for year 1, 2, and 3 to see if you're getting there and how you're going to get there.
Is there a tax benefit to a merge versus?
Yes, you won't pay taxes on a merger. It's an exchange of stock. It's a tax-free transaction until you sell the underlying stock. Now, ESOPs are a wonderful vehicle if you're large enough. As I said before, transactional costs are in the hundreds of thousands of dollars to do an ESOP. But with an ESOP, if it is properly formed, and an ESOP is a qualified retirement plan. It has all of the same rules as with regard to fiduciaries, with regard to administration, as your 401k or any other type of qualified plan. But with an ESOP, basically the owner, if they own C stock, can sell to the ESOP and pay no current income taxes until if they turn around and invest in what's known as qualified replacement property. Qualified replacement property is stock in publicly traded companies, etc. So you could take your portfolio, you could take your company, sell it, and buy a complete diverse S&P 500 portfolio and pay no taxes on any of that money until you actually sell the stock.
That's similar to like a real estate exchange?
It's similar to a 1031 exchange, but there are certain limits on it, and it only applies to C corps. Now, and this is why we'll talk about C versus S again, as I said, a little later. However, the best place for the corporation to be after an ESOP is done is an S corp. Why? Because the sole stockholder is a qualified retirement plan, meaning it pays no taxes going forward. So the idea here is that I have clients that are saying, well, I'm 3 to 5 years out, convert to C now, and then within 2 to 3 years, after you hit your 5-year point in time, because you can only switch S and C once every 5 years, you elect C before the acquisition, you start your 5 years running, and then when you sell the ESOP, they know when you've hit that period of time, they can become an S corp. So this way you can make it a win-win that the seller can get the deferral, and then the company will eventually realize the benefits of being an S corp by not having any tax liability. ESOPs are very hard. Once you go into an ESOP, it's very hard to sell them, because finding someone else who wants to buy it or break up the plan is time-consuming and expensive. But as I said, they can be a wonderful vehicle. I have a client that's going to sell his business for about $3.5 million, and he's not going to pay any capital gains taxes because he's probably not going to need the 3.5. He's not going to have to sell any of the stock for any time soon because he's got significant other assets. So ESOPs can be a wonderful vehicle